Hello, YouTube. My name is Justin, and this weekend we're going to try to find out whether or not there is a massive bull trap that's been set and what exactly we would need to see for the bulls to claim victory. All right, let's jump in. And you're probably noticing this format in this video is going to be a lot shorter because last weekend's video is going to act as a template, and I highly encourage you to go back and watch that long video, which lays out the bear market 2022 explained. If you're enjoying the stream at any time, I would also appreciate you smash a thumbs up and drop me a comment. What are you watching? Do you think this is a bull trap? Is it a bear trap? Or anything else that you're watching this week? All right, let's go forward. So why bull or why bear? These notes are largely the same from last week because not a lot has changed. So what does that mean? There's less thinking required. And what we're looking at now is going to be the feedback loop in terms of what we expect versus what we're seeing on the tape. So the reason why we would be bullish going forward into this next week is that the bottom is in. Why? We got a dovish surprise from Jerome Powell, basically delivering what the market was expecting, but maybe not what the market needed. Earnings reaction is bullish. Microsoft closed up 4% on the week, and Apple closed up 5%. As the largest market cap companies inside the stock market, that really matters. It dragged us higher. So whether or not the earnings were a crush, they did close higher. That reaction was bullish. February monthly higher low. What does that mean? The new month opens up on Tuesday, and we have an established low around 421 on SPY. As long as that holds, it's what? A monthly higher low. There we go. Bearish. Nothing's changed here. Wheels are in motion. And in my opinion, still the base case, we have hit peak cycle. What would be the surprises this week? Geopolitics, again, you know what that means. There's a certain country in Europe which is currently having a little bit of turmoil. Earnings. We are right in the thick of earnings with large cap or the trillion-dollar companies wrapping up on the 3rd. And then we got Payroll Friday. That's going to really matter, especially on the back of that huge GDP print we got last week. Key dates this week are going to include the 31st, which is the last calendar day of the month, and where we're going to close out our monthly candle. And for technicians like me, it really matters where we close out the month because it tells us where support and resistance is found. February, the first of the month, is going to be the first day of the month as well. We got Google after the bell. We got ISM and JOLTS numbers pre-market. On Wednesday, we got Facebook, and we got European CPI for year over year for the month of January. On Thursday, we've got Amazon after the bell. And in pre-market, we have a lot of data. So we got ISM, initial jobless claims, BOE rate decision, ECB rate decision. And then number 4 there is a typo. I've already re-recorded this video twice. Just note the Olympics starts on the 4th. It should be on the next bullet point. I'm sorry for the typo. On Friday, the 4th, we got Payroll Friday, and the Olympics are kicking off where the world is going to be watching. The Olympics end on the 20th, and that's roughly 2 weeks. So there's going to be roughly 2 weeks where the world is hopefully a little bit distracted with what is happening in terms of competition. All right, now we're going to jump over to the S&P 500 charts, and let me know in the comments as you're smashing or destroying that thumbs up. What do you think of the format as we're going to a tighter version where we're trying to present as much data, as much value, but in a shorter format? So looking here at the monthly chart, like we noted before, we're going to do a top down. We're going to look at the market and try to understand what it's telling us. And then we're going to dive deeper to see if there's anything we should notice by kicking the tires, lifting the hood up, and things like that. So on the monthly chart here, this closes out on Monday. Where we land is really important. Closing above 438 gives the bulls a chance. It does not mean it's enough. It just means we get a chance. We can see that as of the close on Friday, we are down by 6.95%. It's a pretty dramatic cut. Biggest red candle we've had in a while here. 449 is going to be key resistance. That's the December low. And then we got 454 as the gateway for the bulls to advance. That is going to be our September all-time high and roughly our October low. Sorry, our November low. Going to the weekly chart here, this is where it starts to get a little bit more interesting. Why? We have the potential, keyword there being potential, for a capitulation bottom where we gap down, pump up with the climax of volume. That's really good. Why? We got a fat green bar here, and we close green on the week. Nice. What's the challenge? We're still in a downtrend, but that downtrend will be broken by going sideways into next week. 428 and 421 remain key support on the weekly chart. Looking here to a shorter time frame, which is the daily chart, it's choppy AF, right? Chop, chop, chop. Tails trump so far. What does that mean? There's nice tails here as we look at the daily chart. So that means basically dip buying or shorts who are exiting their short and locking in gains. We are needing to claim the 200 DMA. And if we do that, that is going to break our blue downtrend here. What does that mean? Well, if we stop going down, maybe we can go back up. That is going to be the early clue for the bulls. 445 and 449 remain big tests. Jumping over here to the hourly chart, here is where it's really interesting because as we note here, the biggest volume, or roughly 105, just over 105 million shares, traded between 449 and 429. What does that mean? These biggest bars right here traded after Jerome spoke, and we basically shot up all the way down and then chopped up into Friday. So that's where most volume is, or the volume profile. So if we can break above the 200 DMA, we break the channel lower on the hour. We make sure everyone has had a chance to sell at least once, and that's how we can go to 445 and 449. Over 442 by Monday close or into Tuesday breaks the channel. Also notable that if we do backtest here to roughly 435, that is going to be the 50 weekly moving average, and 432 is where we have a 10% from all-time high off the top, and that is where we define a correction, 10% off the high. That is it. So that is S&P 500. Let's move forward. And again, I'm aiming for a very tight video, so I might start going a little bit faster. I'm aiming for about 10 minutes, but it's probably going to be about 15. Earnings for this next week. What do we got? The ones that are pink are the ones that are the most important. So after the bell on Tuesday, this is a really important earnings week before I forget. It's really important because we're getting a good mix of different sectors and lots of earnings. So after the ultra mega cap or the $1 trillion are finished off, the market will be focusing on everything else. And here we got AMD and Alphabet reporting after the bell on Tuesday. After the bell on Wednesday, we got Meta or Facebook. And then on Thursday after the bell, we got Amazon. So that's it. After Amazon, that is the end of the $1 trillion companies. Looking here at the heat map for the last 1 week, we can note that Microsoft and Apple are shining bright. Tesla's pretty bright red after earnings. And then we got energy over here looking like it's catching a bid. Credit cards also did pretty well. That is 100% the sign of a healthy market when people are borrowing at 20%. Yeah. All right, moving forward to the 1 month. Oh, this is where it gets a little bit worse. So now we note that what's leading the decline? Well, chips are leading tech, and tech is leading SPY. That is terrible. That is our base case. And even with the snapback of 4% for Microsoft, it is still down nearly double digits at 9.85. What is holding up roughly year to date? Right, some SIGGIs, right, energy, and credit cards. Great, right? That's a sign of a healthy market. Maybe we got our new leaders. Yeah. All right, moving forward. Fear and greed index. It's solidly in fear here. Even with the huge snapback on Friday, the market is still in fear. So just because we're fearful does not mean we can't go lower. The only time we were actually greedy was roughly 1 year ago. Otherwise, it's been fear that is dominating the tape. Notable that it's only fear and not extreme fear. All right, the bull case. Why would the bulls be in control? We summarized it briefly on the second slide, and now we're going to go through and see if there's any catalysts or news events for this week. Doesn't that bull look cute, right? It looks like he wants to go in March, right? He's blowing air out of here. Maybe that's what the bulls got. They got some steam in the tank. Come on, bulls. Why would the market be bullish? Well, retail traders bailed on the market right before stocks rebounded. Right? Retail money flees stocks in departure from earlier dip buying. Again, I'm not going to go through when they bought the dip. You guys should know that by watching the weekend videos. Stock market, stocks roar back with best day since June of 2020. Markets wrap. This is from Bloomberg. So again, Friday is the single best session that we've had going all the way back to June of 2020. And in previous weeks, we were talking about March of 2020. So if the bulls are in control, we should be resuming higher, and that technical analysis on SPY should prevail. Something else that's bullish here again. I don't know if this is bullish, but again, whether it will get a bullish reaction, but this is bullish. Why? The U.S. economy grows at fastest fourth quarter. GDP shows strongest year in decades. So specifically, it is it's capping off a 6.9% annual rate, and it is the strongest year of growth in nearly 4 decades. Oh. All right, here's the bears, right? They look cute until they start coming for your lunch, right? Again, encourage you to pause the slide if you want to read each individual bear market target. These are not all necessarily for 2022, and we've already hit some of these numbers, including 440s, 430s, 420s. Haven't quite got to the 400s yet, and getting into the 300s is where the damage starts to accelerate. So again, pause the slide if you want to see the numbers. We went into 420s, and then we snapped back up to 440s here. Here is where there is an excerpt from an article we're going to read briefly here. The Fed delivered what I expected, but not what I think is needed for sustainable economic well-being. It should have stopped purchasing assets immediately and given a clear signal on rate increases. Instead, the central bank doubled down on its 2021 trade-off of trying to please financial markets at the cost of increasing the challenges ahead for the economy, sound policymaking, and its own credibility. That last word there is most important, credibility. Let's go forward and read what that means. And remembering, the reason why this matters is because we just wrapped up the January 25-26 FOMC meeting, and we are not going to have another meeting until March 15, 16. Remembering that with the asterisks we see here, that is going to be a summary of economic projections and where we are expecting a live meeting for rate liftoff, and also where quantitative easing will be wrapped up. Until then, there will be no official statements from the Fed. There might be people who talk, but there will be nothing official. We're going to look here at what Mohammed El-Erian is talking about, and this guy is important. I'm not going to talk about his credentials, but I encourage you to Google him and see who he is. Fed does what's expected, not what's needed. The central bank should have stopped its asset purchases immediately and given a clear signal on rate increases. So, just because of time, I'm not going to go through and read the article, but here he basically explains what is important for him. And we've already read that headline, which is at the end of the article here. It's not a very long one. I encourage you to just read the article if you're interested. All right, moving forward. These are the rest of the bear headlines here. So Goldman strategist sees risks of growth shock for stocks. Higher rates to tame inflation may dampen economic activity. At the same time, when we're seeing the fastest GDP growth and the fastest inflation in 4 decades. 40 years, sorry, 4 decades. Yeesh. Goldman Sachs predicts Fed will raise rates 5 times this year. They've ratcheted up from 4 to 5. They went from 3 to 4 pretty fast. Now they're going from 4 to 5. Goldman's number 2 takes a rare swing at Fed's autonomy and resolve. Waldron, worries Fed won't do what's needed if markets protest. We might need to bring back Paul Volcker, he tells investors. You're hearing a lot of similarities from what we did last weekend, right? Hopefully. Why the Volcker shock worked. Again, we're going to go to the second paragraph here where it talks about Fed Chair Alfred Hayes tried to fight inflation and recession at the same time as he alternatively raised and lowered interest rates. His stop-go monetary policy confused consumers and businesses. Worried companies just raised prices to stay ahead of the future high interest rates. Consumers kept buying before prices rose even more. The Fed lost credibility and inflation rose to double digits. Let's take a second here just to understand what this means. Let's go back to the previous slide. We might need to bring back Paul Volcker. Why? Right now, Jerome Powell is what? Losing credibility. We talked about it briefly on the slide. And again, Mohammed El-Erian is a really important person. So is Goldman Sachs. They're sounding the alarm bell. So again, they're opting for they're basically saying they don't really care as much about sound policy making and its own credibility. Those are mega warnings if you are bullish. All right, let's move forward. I'm already at about 15 minutes, so maybe it's going to be 20. I'm sorry. I'm trying my best to make these short. Just I don't want to rush myself too much. Crypto winter feels chill. The battered Bitcoin faithful. Yeesh. Right? Yikes. And this is from Business Insider. Get ready. The Fed is popping the everything bubble and catapulting the stock market into chaos. Whew, that's a nice headline, right? One more just to top it off. Bridgewater says Fed won't blink before much bigger stock drop. Co-CIO Jensen says Fed could tolerate a decline of 15 to 20% more. Whoa, that gets us where? Into the 300s on SPY. ETFs. All right, let's go over to ETFs now. So I'm going to go through this section a little bit faster, but again, pause the video, replay it again if you want to see everything. So QQQ, again, similar to SPY, we have the potential for a capitulation bottom because we gap down, pumped up, and we also have that climax of volume. That is a fat bar down here. We saved the 350 key area or the green arrow, basically going back to this October low. Reclaiming the 50 MA or roughly 359 means we break the downtrend. Going sideways at 350 for one more week also breaks the downtrend. That is how the bulls can retake control of these charts. Looking at, just a reminder too, that a dead cat bounce is when we bounce, test the low, but fail to take out the high. So next week, if we form a higher high and a higher low, that is the first sign of a trend change from going sideways to going down to going sideways to potentially going back up. XLF, open on the 50 MA, pumped up. Save the apex and we'll be opening right on it next week. XLV, open on the 50 MA and pumped up. It saved the lower uptrend or the blue line. There's also volume. Looking here at IWM, this is trash until proven otherwise. The chart stinks. DIA, massive volume, right? Huge, notable volume. 355 would reclaim the weekly uptrend next week. NYSE, we got roughly a Dragonfly Doji, right? Indecision, closing roughly where we opened. RSP or equal weight SPY, we have a spinning top right on a key area of 153 and just over that 50 MA. XLE, big power up. It is pumping up. XLU or utilities, 50 MA bounce, but we are stuck between this lower and upper uptrend. ARKW, this is the psychology chart 101. TNX, it looks very similar to XLE for me. What does it mean? It's building up pressure for a sustained break over 20, which would equal 2% on the 10-year note. VIX, impressive stomp. They smacked it down back below 30 to close the week out with a shooting star, and that usually means downside. I happen to think it's a trap and we go higher. We have an apex for 29 in roughly 2 weeks. XAU or gold, we can see that the inverse head and shoulders is holding on the weekly chart. And on a monthly chart, we notice that we're getting a back test of our breakout right into the apex here. Really, really, really big number. BTC, if winter is here, we're not going to get back above 41K. Getting back above 41 signifies an attempt at a reversal for me. And DXY had a massive week so far. I think it was up like 1.5%, which is huge for the dollar. I would also note that as we close out the monthly chart on Monday, DXY is primed for a monthly bull break by closing above 97, and 100 would be the next stop after that. Options, yeah, bringing it back because you guys asked for it. So again, definitely takes more time to go through and do these, but you guys asked for it, so here it is. Whoops. There we go. Got the right screens up. Here we go. S&P for next week. Monday, 440, 450 call spread. Again, pause the video if you want to read everything. I have to go through fast. 440, 450 call spread. We got put flow here at 430 as well for Monday. On Wednesday, we got continuation at 435, 440, 445, and 450 calls. And then that should say Friday, 440, 445, and 450 call continuation. We got 33K in volume at 450. So there's an attempt by the bulls here to get it back above that monthly low at 449. There we go. Looking at the monthly chain here for SPY, the calls are MIA. Where are they? I don't see them. There's no calls. There's only 440 for open interest. That is the only stack that has more than 10,000. We got 448 to 480 puts, though. They are heavy. Looking here to beyond the 16s, we can note that there's 450 calls. Let's go beyond the 15s here. So we got 450 to 460 call spread. And then we got 450 to 440 call spread. Also notable that there are fat puts all the way down to 400, 430, 422, 420, 415, 412, and 400 are notable areas. There is volume just gushing here too. So that's what I mean by this is the textbook sign for me that that massive day on Friday is a bull trap. They stomped the VIX, they bought a whole bunch of puts, and I don't see any call buying. That is a red flag for me, not a yellow flag. Looking out here to the QQQ for next week, largely the same. Again, basically track SPY, 350 calls, 350 to 344 puts. That's it. Looking here at Wednesday, muted. Looking at Friday, there's only a little bit of calls. It's MIA. Looking out to Fed monthly for QQQ, what I'm noticing here is we have a 350 straddle implied by the volume of roughly 15,000 apiece. That is it. Otherwise, it's all bearish. Looking beyond the 16s, we can note that there's in the money puts versus muted out of the money calls. There's barely any calls, but these puts have not been called in. They want to hold on to them. Even with all the burn they got on Friday, they're holding on. Looking beyond, there is fat out of the money puts, notably between 335 and 330. We got 62,000, 63, and 66,000. Those are big numbers here. And the takeaways for me are this. I'm going to go through one more here. I'm going to look at this one here again. There is a lot of volume here. I went through the indices, the ETFs, and each underlying stock. What I'm noticing here is that on Monday, they were buying calls, 4,600 to 4,800 SPX. Premium is meh compared to previous buying for a single day. It's at about $20 million per strike. It's not huge. We were seeing like hundreds of millions of dollars before. So 20 million is not nothing, but it's still a meh. On Tuesday, they're buying more calls, 4,600 to 4,800. On Wednesday, we see massive puts, and this is when Jerome spoke. So people bought a whole bunch of puts, 4,500 to 4,300. And these are $50 million orders, or 2 times as big as the calls. We see 44 to 4,300 for March, $50 million orders. Thursday, mostly continuation. And on Friday, meh, which means people were positioned. So again, I have all the stuff laid out in Slack if you want to go read each individual little post, but I have notes right here I'm going to read to summarize it. The takeaway for me is this. Put buying early in the week, hundreds of millions of dollars. The put buying mostly exhausted by Wednesday and Thursday post Jerome Powell. SPX and NDX had their best single day on Friday since June of 2020. Kudos, bulls. And then the VIX got stomped back below 30, and I believe they're beginning to scrape all those puts they had to sell. When you get paid hundreds of millions of dollars in premium, you got a lot of buying power to go buy S&P and then go buy the NASDAQ. This looks like a bull trap to me. It looks like a textbook bull trap. Come on, Jerome. Don't do us like that. Reminder, Jerome spoke on Wednesdays. So what this looks like to me is that they either bought insurance or there are bear bets into Wednesday with VIX jacked up above 30. What does that mean? Paying a lot of premium for those puts. And they didn't mind. They bought heavy. Powell delivered what Powell delivers. Fed does what's expected, not what's needed. So what does that mean? The hangover is going to be worse when it finally comes. Apple and Microsoft close up 4% and 5% each, the 2 largest market cap stocks. Common sense tells you if the stocks shrugged this off and the market closed up on Powell, basically talking on Wednesday, it appears resilient. It appears more resilient than anticipated. They can/should go more hawkish, like Goldman Sachs said, with 5 hikes. So this is actually bearish. It's more bearish. And as we get to here in the last slide where it says, good luck this week, that is it. I think this is the shortest video we've laid out on this channel yet. And please make sure to drop me a comment to tell me what sections you absolutely want to have in there and which ones I can probably trim out to make more time for just focusing on what's most important here. So I'll leave you with this. I'll leave you by saying that, looks like the camera's not in focus. I'll leave you with this, where you have to make sure you are legitimately prepared for the upside, legitimately prepared for the downside, and please, please, please be prepared for a surprise. The safest time to enter bullish will be on February 3rd, 4th, when we have big tech out and where we have that payroll Friday number in. I wish you the best of luck this week. And if you wouldn't mind smashing that thumbs up and dropping a comment, I would personally greatly appreciate it. Thank you very much and good luck.